Welcome back, traders and investors. We have Todd Schoenberger on the line. He is president of J. Streicher Asset Management, and I can attest Todd has been on the show before, and he has been extremely bullish. You still got your bullish hat on today.
I sure do, Joel. Haven't left it.
Okay, all right. I mean, are you wearing it proudly here, or are you just kind of wearing it to the side a little bit, or what are you looking for this week?
Oh no! I'm wearing this thing loud and proud. Look, you have a couple of things here. This market right now continues to move higher, as you know, but there is very little that's going to be in the way that's going to derail this bull market. And so, all of your listeners should anticipate higher highs, not only in the short term, but probably well into 2015.
Okay, so you don't think Mr. Draghi is going to upset the apple cart? Our previous guest, Chris Temple, was thinking, he's trying to pull the wool over the rest of the ECB. What do you think? You think he's going to pull off QE in Europe?
Yeah, if it happens or if it doesn't happen, it's irrelevant to the domestic stock market, and here's why. You can look at all of the challenges that U.S. investors have had to face, and you go back to the first quarter of this year. You had a minus 2.9% GDP print. You had a polar vortex. You have the geopolitical events that are taking place overseas. So when you look at traditional challenges, you would suspect that the markets would have sold off just on those types of headlines. However, the market has yet to see a 10% correction in over 3 years now. So that tells me that what would be a traditional, really a challenge for the markets, just is not there. And therefore, because interest rates are so low and earnings remain decent, we can only suspect. And now the economic data has been fairly decent with the most recent GDP number. You can only suspect that the stock market is only going to continue to rise for the rest of this quarter, and obviously for all of the fourth quarter.
Okay, and not looking for any surprises from the unemployment number. Obviously, if we slip below 6%, and it might put a little pressure on the Fed to bump up interest rates. You looking for any surprises on Friday?
Well, I'm not. I still think we're going to have a number that is going to be on the headline, will look decent, say at the 200,000 threshold. The problem is, though, is the jobs that are being created are the low-income variety jobs. You're not seeing jobs in this country that are going to be your high earners, where you're going to have people that will have these jobs and be able to afford cars and homes and durable goods, for example. We just don't. The data just the jobs data just does not support a robust, high-earning type of economy. Now, with that said, though, the headline number is enough to get your attention to give the average American the feeling that, okay, things are improving. That does help with sentiment. But what really helps with sentiment is looking at your 401k statement every quarter and seeing that it's just continuing to rise, and you don't have to put a lot of effort in it to get it to rise. So that will continue. You'll have sentiment readings continue to improve. We actually had a fairly robust back-to-school shopping season, which does actually equate to which should be a great holiday shopping season. So with that and with the jobs numbers that we're seeing, it's still, we don't have that nuclear type of event that's going to keep that's going to bring the bears out of hibernation. So if you're not a buyer now, I really don't know what else you need to see to bring you into the market.
Okay, so let's say you are a buyer out there and you don't have an appetite for buying things at new all-time highs like Apple or Berkshire Hathaway, something like that. Where can you still find value in this market?
I would tell your listeners to simply look at the calendar. If you look at certain, here we are in September, and you just finished what many would say is the travel season for Americans. One sector that never gets picked up is this travel and leisure index, this travel and leisure sector. Companies like the Hyatts, the Southwest Airlines, Marriott, or Delta Airlines, these are companies that continue to just excel. They outperform the broader averages, and they're doing exceptionally well. And that says to me that people are traveling. You have people that are obviously going into these hotels. The average daily rate for Hyatt, for example, was the highest um, this summer than it has been over the last 10 years. So when you start thinking of companies that are making money and it's almost just a cash flow machine, it's these travel and leisure companies. So I would actually suggest, and I would, if you're really going to look to get into equities and you want to really dissect certain sectors, I mean, the real, everybody knows about oil companies and having those in your portfolio, but take a look at the travel and leisure index, because it's something that people know and can really put their arms around. They see the commercials, and but now you're really going to start seeing those earnings come in based on all the travel patterns that we just saw over the summer, and that should bode well for higher highs for those stocks in that index.
And what is the symbol on that index? For the travel index? Do you have that in front of you?
I believe it's TJTLX, and for Dow Jones Travel and Leisure, but companies like Hyatt, the symbol is H as in Hyatt,
Right.
Delta is DAL. So there's a number of key ones there. I think you'll be your listeners can easily research and really get their arms around.
And I guess if you wanted to go with that play, you could look at the House of Mouse here, Disney, and that stock is trading just off all-time highs, so that's a better-known travel and leisure stock. They got a few other things going for them, ESPN and whatnot, but that's one sector definitely to keep an eye on. So what looks a little, is there anything here that's on your sell radar? Just a little bit overvalued, maybe taking profits in something, a little bit of a run, too far, too fast? Is there anything, or are you just looking at something and if you want to sell it, you just go out and buy more?
Well, I tell you what, the real estate sector, I have been extremely bearish on this sector for some time. And actually, the housing data we received last week was better than expected. And what happened was it caused a bump for a number of home builder stocks, companies like Toll Brothers, for example. That is an artificial appreciation in that stock. So if you're looking if you want to sell something and try to take advantage of going short, I would look at some of the home builder names that are out there. I mean, we had a bit of a bump, like I said, last week, a great opportunity to get out, because here's why. The 1 month does not make a housing recovery. And if you look at the spring, if you look at the metrics of the spring, we were anticipating that great Gatsby year for real estate. We were anticipating people coming out and just buying these homes left and right, which would be great for the home builder stocks. That did not happen. We actually had construction starts that had dipped below 900,000. The number that came out last week shows over 1 million, which is a key threshold. But the springtime is when that number should be at 1.1, 1.2. And once that number dipped to below 900,000 in that peak home buying season this past spring, that means the third and fourth quarters, and this is just looking at history, but third and fourth quarters means that you're not going to have a lot of people going to contract, going to settlement, buying homes, because there weren't any being built in the spring. So when you hear about that, you can only suspect that there's going to be a great deal of pressure going into the end of the year on the home builder stocks. Companies like Lennar is another one you might want to really stay away from. And that real estate sector is really going to be the only thing that's helping it at all is the stock market. If you do have any type of a sell-off, whether it be maybe a 5% correction, the spillover effect on real estate is just going to be significant. So it's one of those areas the risk is just way too high to be in that sector right now. I'd stay far away from it.
And Toll Brothers, who's due to release earnings this week, has had a monster run up from its August lows and bumping its head up against the $36 level. Tried to peek through this morning, but coming back down. So perhaps something that you want to take a little bit of a flyer on ahead of earnings. Also, I could kind of attest to in the housing market, blaming on the weather or whatnot, but the market was pretty tight going back. Early spring and summer wasn't a lot there. It was much of a seller's market, and now, and at least in our area, it's starting to turn a little bit in a little bit more buyer's market. Things, a little bit more stuff coming for sale here. Maybe people that were trying to sell the top are having a little bit of regrets. But we just got a symbol that popped in here from Colt's Luck. He's been patient here. Do you follow AstraZeneca at all? I mean, they were being courted by Pfizer. That deal fell through. Things have been kind of quiet. It's come back down. Is that a company you pay much attention to?
I don't pay attention to it, but I will say this, though, and this is great for your listeners. You should expect a lot more merger and acquisition activity for the remainder of the year. There is a clear threat of inflation. And what happens with companies is that you need to continue to show that your revenues are obviously growing every quarter. I mean, every quarter they have to give a report card to their shareholders to tell them that revenues are growing. And what we've seen this year, especially in the M&A side, and you've seen a lot of this in the oil industry. We actually, so far for the first 7 months of the year, we've seen $1.2 billion in M&A activity in the oil sector. This is about 50% higher than it was the same time last year. And a big reason for that is because of inflationary concerns. Companies feel that they're not necessarily having to look for increased market share. However, that's a benefit of any buyout, but they're really looking for that revenue stream. And that's going to help, especially in an inflation environment, because now you're going to have companies that still see that revenue growth, revenues coming in. They obviously see their operating costs going higher, but you will be seeing more M&A activity. And I think that probably for the rest of the year, don't be shocked that today being Tuesday, we heard of a deal in travel and leisure actually with the cruise lines, but every Monday from here for the rest of the year, don't be shocked if you start hearing about big merger and acquisition activity, some big buyout, multi-billion-dollar deals that are taking place, and that's one sector that you're going to see a lot of that in. So it's something to just keep an eye on. The trick, though, is trying to guess which companies are being taken over, and if you can figure out that secret sauce, that's great, because you should do well with your portfolio.
Isn't that something that might bode negative for the market long term if these companies are just trying to mask, small or negative growth with acquisitions to boost their earnings, to fight off inflation? Wouldn't that be something that would have a long-term negative impact on the market?
That's right, because history tells us that is the case. When you have any type of an increase like that in M&A activity, it typically could be a sign that not only is it bad for the markets in the short term, it actually can signal a market top. This time, I believe, and that could very well be the case quarters down the line. But right now, the stock market continues to rise, and I think a lot of companies see that as valuations continue to increase, and if they are expected to increase for the rest of the year, you can almost look for some companies at, what will be relative to terms of where valuations could be in months from now, but realistically at a discount. And therefore, if they can get cash flow in the door and close some of these deals by year end, that means they're going into 2015 with an additional stream of cash. And that is a big deal for shareholders just to keep in mind. But like I said, the guessing game is there, trying to figure out which companies are going to be bought. But you're going to hear a lot of these things. I will share this with you. This was a very, very busy August on Wall Street, and there was typically the feeling is August is the slowest month because people go on vacation, trading volumes drop, and there is some truth to that. However, there was quite a bit of activity with meetings taking place, conference calls, a lot of activity for bankers, and that just says to me that since August was busy, that's going to translate to a very active September and October, which usually means a lot of M&A activity. Just something for your listeners to keep an eye out on, but don't be shocked if you start hearing about many, many more multi-billion-dollar deals released every Monday morning from now for the rest of the year.
Before I let you go, Todd, I gotta ask you, and you must have some pretty good moles out there if you know that there's been meetings and conference calls and stuff going on in the banking sector. What do you use for an indicator on something like that?
Well, for us at J. Streicher, fortunately we went through this August at extremely busy, and I'm not suggesting that we're involved in any M&A activity at all, but just from our perspective, from a growth perspective, as a Wall Street firm, I know that we've been growing, but just from talking to friends and colleagues throughout the industry, it was a very active August. You didn't have a lot of people taking vacation, and even the ones that did take vacation ended up being called in back to Manhattan, or they were jumping on calls. And I don't know what the purpose of these people having these conversations were, but the point is, it clearly is business related. And when you start seeing that and hearing those types of stories, that generally translates to a very active fall. And so, like I said, I wouldn't be shocked if you start hearing about a lot of investment banking activity, and that would be fantastic. And for some of these deals, and I think it's great for the markets too. It makes things exciting, obviously, and it just shows you that Wall Street wasn't just asleep at the wheel in August. We were actually working.
Okay, well, you've given us good insight. The previous times you've been on the show, you've done it again today, Todd. Really appreciate it. Todd Schoenberger, president of J. Streicher Asset Management, giving us a well-rounded view of the markets. Well, we'll let you get to your opening trades there, and we'll talk to you again soon.
Sounds good, Joel. You take care now.
Okay, thanks, Todd.